Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Whilst the long-term economic impact of COVID-19 remains uncertain, emerging markets have stabilised following significant falls. We're going to discuss the impact of coronavirus today. Could current valuations provide investors with a great opportunity to buy into the long-term growth of the world's most dynamic economies? Or is it still too early to say? To discuss the outlook for emerging markets, I'm delighted to be joined by Ross Teverson, co-manager of Jupiter Emerging and Frontier Income, and Andrew Ness, portfolio manager of Templeton Emerging Markets. Right, on to the questions. Ross, what has been the impact of coronavirus on your portfolio?
Well, when we entered into this year, we had a significantly lower weighting in China, instead identifying a number of underappreciated opportunities, we feel, in other markets across a whole range of geographies from Mexico to Russia to Turkey. So far this year, China's been surprisingly resilient as a stock market, holding up better than other markets. And so having a lower weighting in China has been a headwind for us. As has having a higher allocation to small caps. What I would say, though, is that for the companies that we own, that we have purchased for high conviction, bottom-up reasons, the investment case very much remains intact. So we haven't significantly altered any of the positioning within our portfolio.
Right, so it stayed pretty much the same.
That's right. We've obviously made a few changes as we would during any quarter, but the overall nature and characteristics of the portfolio remain the same as they were at the start of the year. And we feel that with valuations having come off the way they have, for many of our holdings, the long-term investment case really does look very compelling as of today.
So Andrew, what has been the impact of coronavirus on your portfolio?
Thanks, Annabelle. It's very much a similar answer to us, actually, that our portfolio experienced much of the same selling pressure and price volatility seen across all global funds over the last few months, including the subsequent recovery in prices that we've seen in recent weeks. If we look at the portfolio going into the crisis, we were pursuing a very much a diversified approach within our strategy. Our stocks were reflecting our philosophy of owning good quality businesses with long-term sustainable earnings per at a discount to their intrinsic worth. We typically look for well-capitalized businesses. We're highly cognizant of leverage. We prefer lower or appropriately leveraged companies. And the crisis hasn't altered our investment philosophy towards emerging market stocks as a consequence. So it shouldn't surprise you, but we've not made significant changes to the portfolio on account of the crisis. Although we have, at the margin, we've reduced or exited some investments in companies where either we believe there's longer term negative impact on the business, or indeed where share prices haven't corrected in line with the expected negative impact on the business. But overall, we're comfortable with the balance of the portfolio today.
Well, that's encouraging. Andrew, where are you seeing opportunities at the moment?
We currently favour companies that are exposed to areas of structural growth and have scope to gain a higher market share through their competitive advantage. Now, whether that's through their cash flow generation, their existing market share, or technological leadership. So for example, online entertainment, gaming, messaging platforms, the fact that we're doing this today, these have all seen greater use during the coronavirus lockdown period. And that's driving the insatiable demand for data and fast broadband speeds that will in turn drive growth for cloud and other network architecture names. And that increases demand for servers and other memory intensive devices. We also think that the emerging market consumer, it's a well-trodden path, but it still remains an attractive opportunity. Although clearly the economic impact of the virus is going to weigh on many economies in the short term. However, the consumer trends that we've been investing in for some time are likely to remain relevant. Just as a quick recap, these are low penetration, where many parts of emerging markets, they still lag developed economies in the penetration of goods and services. Now, whether that's home ownership and mortgages, it's car ownership, it's life insurance, it's the penetration of high-speed broadband, we think many of these opportunities still remain. Now, in addition to that, in some of the more evolved consumer economies in emerging markets, where there's already a significant mass affluent portion of the population, whether that's in China, it's India, it's in Russia, it's Brazil, North Asia, we'd expect to see an ongoing premiumization trend where as these consumers have got wealthier, they like to trade up for higher quality services and brands, and it's no different from consumers in the developed world. And again, we think that this theme will remain broadly intact post-virus. And finally, wellness and health. This was a fast-growing sector pre-crisis, and we'd expect continued growth as societies reevaluate their lifestyles post-crisis.
You said a lot of things there that really chime true to me in terms of our dependence on technology to live, to work, and the importance of health and wellness at the moment. That's it. So now, Ross, where are you seeing opportunity?
Well, I'd certainly second Andrew's point about the technology sector. So a number of our technology holdings have actually delivered quite strong results so far this year, and are guiding in quite a reassuring way. So the outlook remains quite positive for a number of those companies. I think what is an interesting element of that sector is that a number of companies within the tech space have got net cash balance sheets. So they are sitting on net cash rather than using debt in their business. And that obviously makes them particularly resilient. But I'd also highlight that that isn't just a characteristic of the tech space. Actually, across a whole range of geographies and sectors, we identify companies that are net cash in terms of their balance sheet position, and which enjoy a very positive long-term growth outlook. So I could find examples or give you examples within, for example, the Indonesian property sector, the Chinese pharmaceutical sector, Pakistani autos. So really quite a range of different companies and markets. And when you've got companies that are well positioned to weather this difficult period, however long it persists, I think we can own those with confidence, knowing that they will be well positioned to benefit from the longer term growth opportunities that really attracted us to many of these names in the first place.
Now, I think coronavirus has really put an emphasis on ESG. So how are you incorporating ESG in your investment approach, Ross?
So we believe that ESG is integral to an emerging and frontier markets investment approach. For us, there are three areas that we put particular emphasis on. So one of those is alignment, alignment of management or controlling shareholder with all of us as minority investors in a business. So ideally, we'll see that alignment in the form of long-term equity-based compensation plans, which have got sensible targets and timeframes in place. The second thing that we're looking for is good capital management. So we want to see management teams running efficient balance sheets and returning cash to shareholders where appropriate, and certainly not using inappropriate levels of debt. So capital management is the second point. And then the third point is that we're looking to ensure that the companies we invest in are appropriately mitigating environmental and social risks, and thereby minimizing risks to the business in the long term. So all three of those are important. They're all elements that we consider carefully when researching and investing in businesses.
Yeah, I think inappropriate levels of debt is something that we've really seen now through this crisis, the companies suffering as a result of that.
Yes, that's something that becomes particularly apparent, as you say, in a time like this. And it is a general characteristic, I would say, of emerging markets that balance sheets tend to be more conservatively managed than those in developed markets.
Now, Andrew, how do you incorporate ESG into your investment approach?
Well, one of our core beliefs and one of our starting points is that we're responsible stewards of our clients' capital. And the way that we define stewardship means that assets are entrusted to us and we safeguard them, and our ambition should be to ultimately return them in better condition than when we received them. And in addition to our belief in being responsible stewards, we also believe that ESG factors do create risks and opportunities for companies, as Ross just outlined. It's therefore in our clients' interests for us to consider these factors when investing in a company. And it's also the companies themselves need to manage these factors appropriately. So when we look at that in practice, what it means is we're seeking to understand management motivation. We're looking at the governance mechanisms. Are these appropriate? How does a company create value? We need to understand the culture of the business and also identify material ESG factors that can impact a company's ability to generate sustainable returns. So ultimately, we want to assess management's understanding and preparedness for these factors, and then how they themselves incorporate them into their strategy. Now, I think it's also important to state that stewardship and ESG integration, these aren't about imposing our values or our beliefs on clients' portfolios. I think rather it's a framework for an objective assessment of a company's management and its future business prospects. And I think it's also important to state that we're not simply screening for best-in-class attributes at any price. We typically think of ourselves as pragmatic investors. We recognize that the world is imperfect, the perfect company rarely exists. But they're also rewarding return opportunities by investing in companies with good operating models, but potentially imperfect ESG performance, where our active ownership and engagement can achieve change and positive outcomes for all stakeholders.
Yeah, well, positive outcomes for the stakeholders is clearly absolutely critical.
I think we're now evolving. I think that the world that will have emerged from the coronavirus will be very different. And I think one of the ways it will be different in terms of societal expectation of what corporates are there for and what good corporate governance looks like. And I think that's going to be quite a fast evolving model over the coming years.
Yeah, I think you're right. And I think that will be very interesting to see the development of that. So moving on, what is your outlook for the sector going forward? Andrew?
I think the immediate outlook, not just emerging markets, but for the global economy, remains highly uncertain. And I think it's difficult to assess the negative impact on growth and corporate earnings in the short term. However, the way that we deal with that, we believe that our philosophy of owning good quality businesses with some embedded, sustainable earnings power at a discount to intrinsic worth, we think that will help us navigate coming months. And over time, we would expect those long-term fundamentals of our holdings to remain intact. Specifically looking at the asset class, domestic recovery in North Asia, as well as lower oil prices, they're supportive for a number of countries and markets. But the extent to which stimulus policies can offset demand destruction still remains to be seen. If we look at valuations, in absolute terms, they don't look particularly cheap, but in a relative context to developed markets, they do look more appealing than they have for some time, although there is going to be significant volatility in earnings forecasts over coming months. For example, there's going to be substantial hit to Q1 earnings for sure, Q2 earnings as well, due to the supply shocks and weaker demand globally. We may see some normalization and recovery in the second half of the year, but we certainly can't rule out delayed recovery should there be a more prolonged and severe global recession.
Right, so it's still a little bit too early to tell, but some long-term positive trends.
Yeah, I think so. At this point in time, too many uncertainties to be very confident in predicting outcomes.
And Ross, what's your outlook for the sector?
I'd agree with a number of points Andrew's made. I think it is very difficult to have a high degree of confidence over what earnings for different companies look like over the next couple of quarters. Of course, I think we can take some reassurance from the fact that we're seeing social distancing and lockdown measures starting to ease in some markets. It means that investors can start to at least look through the very nadir of this crisis. But what I think is really important when times are uncertain as they are right now is to look at valuations and recognize that when valuations are as low as they are for some emerging and frontier market businesses, and some emerging and frontier market businesses are trading right towards the bottom of their long-term ranges, when they're that low, it is always the case that it is accompanying a period of significant uncertainty. But it's also true that those low valuations have typically resulted in good long-term returns for investors. They've typically created good long-term buying opportunities. So I think it's just as important that we focus on the valuations and where they are in a longer-term context and how emerging market and frontier market valuations look versus developed markets, as it is looking at what the earnings outlook may be like over the next couple of quarters.
Yes, I mean, I think it's really understandable that you're both very cautious. But, brave investors in the past have invested at times of great uncertainty, and over the long term, they have very much been rewarded for doing so.
That's right, and I think that is why it is so important to keep valuations in mind, rather than being too focused on what developments will be from month to month.
Well, thank you very much. I'd like to thank our managers very much for joining us today. It's great to hear their views on emerging markets, but I'd like to emphasize we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. All that remains is for me to wish you and your family well. Thanks so much for watching.